Something extraordinary just happened in the silver market that most investors completely missed. And if you understand what I'm about to show you, you're going to see why the next few months could rewrite everything we thought we knew about precious metals investing. Silver just hit levels we haven't seen in decades. We're talking about a metal that was trading under $29 at the start of the year, now pushing past $66. That's not a rally. That's not a bull market. That's a complete structural shift in how this market operates. But here's what's really fascinating. While silver was making this explosive move, the stock market was doing its own thing. The S&P 500 had its moments of volatility. Tech stocks were all over the place, and yet silver just kept climbing. It didn't care what equities were doing. It didn't follow the traditional correlations. It broke free. And that decoupling? That's the story nobody's talking about. Because for decades, silver moved in lockstep with risk assets. When stocks went up, silver went up. When stocks crashed, silver got hammered. It was predictable. It was reliable. Fund managers could model it. Algorithms could trade it. Not anymore. Let me show you what's really happening here, because this isn't just about price. This is about a fundamental transformation in how silver functions in the global financial system. And the implications are massive. First, let's talk about what decoupling actually means. When we say an asset has decoupled from another, we're saying the historical relationship between them has broken down. The correlation that traders relied on for years suddenly doesn't work anymore. And in silver's case, that correlation with equities was one of the most consistent patterns in commodities trading. Think about what happened during the pandemic crash. March 2020, stocks collapsed and silver got absolutely destroyed. It went from over $18 down to nearly $12 in a matter of weeks. Classic risk-off behavior. Investors were selling everything that wasn't nailed down, and silver went right along with it. Fast forward to the recovery. Stocks rallied hard through 2020 and 2021, and silver followed. It peaked around $30 in early 2021, then pulled back as the broader market consolidated. The relationship held. Silver was still behaving like a risk asset, but something started changing. Quietly, at first. You had to be watching closely to see it. Silver started responding to different signals. Industrial demand numbers that used to barely move the needle were suddenly driving significant price action. Supply deficit reports that the market used to ignore were getting serious attention. And most importantly, silver stopped selling off when stocks had bad days. That's when smart money started paying attention. Because when a correlation that's held for decades suddenly breaks, it usually means something fundamental has shifted in the underlying market structure. So what changed? Let's dig into the mechanics, because this is where it gets really interesting. The first major factor is the supply deficit, and I'm not talking about a small shortage. We're looking at the fifth consecutive year of structural deficits in the silver market. The Silver Institute's data shows global demand consistently outstripping supply by hundreds of millions of ounces. That's not a temporary imbalance. That's a long-term supply crisis. Now, you might be thinking, okay, supply and demand, that's basic economics. But here's what makes silver unique. Unlike gold, which is primarily a monetary metal and a store of value, silver has this dual nature. It's both a precious metal and an industrial commodity. And that industrial demand? It's absolutely exploding. Solar panels are the big story here. The renewable energy transition isn't some distant future scenario anymore. It's happening right now, and silver is at the heart of it. Every solar panel requires silver for its photovoltaic cells. There's no substitute that works as well. And as countries around the world ramp up their solar installations to meet climate goals, that demand is going through the roof. The Silver Institute projects that solar demand alone could consume over 200 million ounces annually. That's roughly 20% of total global silver supply going into just one industrial application. And that percentage is growing every year. But it's not just solar. Electric vehicles use significantly more silver than traditional cars. The electronics boom continues unabated. 5G infrastructure requires silver. Medical applications are expanding. The industrial demand side of silver is firing on all cylinders, and there's no sign of it slowing down. Now, here's where the decoupling really starts to make sense. When silver was primarily trading as a risk asset, Its price was driven by investor sentiment and correlation with equities. But as industrial demand has become the dominant force, silver's price is increasingly driven by physical fundamentals rather than financial market sentiment. Think about what that means. A stock market correction used to trigger automatic selling in silver because algorithms and traders expected the correlation to hold. But now, even if stocks sell off, you've got this massive industrial bid underneath silver that doesn't care about the S&P 500. Solar panel manufacturers need silver whether the stock market is up or down. EV producers need silver regardless of what tech stocks are doing. That physical demand creates a floor. And more importantly, it creates a different price discovery mechanism. Silver isn't just reacting to risk appetite anymore. It's responding to actual supply and demand dynamics in the physical market. But there's another layer to this story that's even more compelling. The investment demand side is changing too. And this is where it gets really interesting for anyone thinking about wealth preservation and retirement security. For years, silver was seen as gold's volatile little brother. It moved faster than gold, both up and down. It was more speculative. Traders loved it for the leverage. But serious wealth preservation investors often stuck with gold because it was more stable. That perception is shifting. And it's shifting because investors are starting to understand silver's unique position. It has the monetary metal characteristics of gold, the scarcity, the history as money, the store of value properties. But it also has this industrial demand component that gold doesn't have. That combination is incredibly powerful. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, and you're thinking about how to protect that wealth in an environment where traditional correlations are breaking down, I put together a free guide on how gold IRAs work. It covers how to get physical precious metals into your retirement account without tax penalties, and it's in the description below. Worth checking out if that's something you're considering. But back to the decoupling, because there's more to this story. Let's talk about what's happening in the paper markets versus the physical markets. This is crucial to understanding why silver is behaving so differently now. The COMEX, the major futures exchange where silver is traded, has been showing some really interesting patterns. For years, the paper market dominated price discovery. Massive positions in silver futures contracts would move the price, regardless of what was happening in the physical market. Banks and hedge funds could trade hundreds of millions of ounces of paper silver, and that would set the price that physical buyers and sellers had to accept. But the physical market is asserting itself now. We're seeing persistent tightness in physical silver. Premiums for physical coins and bars have been elevated for months. Delivery delays are common. And most tellingly, the amount of silver in COMEX warehouses has been declining even as prices rise. That's not normal. Usually, when prices rise, you see more metal flowing into warehouses as holders look to sell into strength. But we're seeing the opposite. Metal is leaving the warehouses. It's being taken for delivery and moved into private hands or industrial use. That suggests the physical market is much tighter than the paper market pricing would indicate. And here's where it connects back to the decoupling from stocks. When the physical market is this tight, price becomes less sensitive to financial market sentiment and more sensitive to actual supply and demand. A stock market sell-off might trigger some paper selling in silver futures, but if there's strong physical demand, that selling gets absorbed quickly and the price stabilizes. We've seen this play out multiple times recently. Stocks have a bad day, silver dips briefly, then recovers while stocks continue lower. That's not the old correlation. That's a market that's responding to different drivers. Now, let's talk about the institutional side, because this is where the story gets even more interesting. Central banks have been massive buyers of gold for years. Everyone knows that. But silver? That's a different story. Central banks don't typically hold silver reserves. But other institutions are starting to pay attention. Investment funds focused on the energy transition are looking at silver as a strategic metal. They're not buying it as a financial asset. They're buying it because they understand the supply constraints and the critical role it plays in renewable energy. That's a completely different type of buyer than the traditional silver investor. And then you have the retail investment surge. The physical silver market saw unprecedented retail demand over the past few years. Coins, bars, rounds, all of it. And that demand hasn't gone away. It's stabilized at elevated levels. Those are long-term holders who aren't trading based on stock market movements. They're holding physical metal as a wealth preservation strategy. All of these factors are creating a market structure that's fundamentally different from what we had before. Silver isn't just a leveraged play on gold anymore. It's not just a risk asset that moves with stocks. It's becoming its own thing, driven by its own unique set of fundamentals, and the price action reflects that. Look at how silver has performed recently. It's up over 127% from its lows. That's not a correlation trade, that's a fundamental revaluation based on supply and demand. But here's what really matters going forward. If silver has truly decoupled from stocks, what does that mean for investors? What are the implications? First, it means silver could continue to perform well, even if stocks struggle. That's huge for portfolio diversification. One of the main criticisms of precious metals has always been that they don't provide true diversification because they tend to move with risk assets during major market stress. But if that correlation has broken down, silver becomes a much more attractive portfolio component. Second, it means the price discovery mechanism has changed. Instead of watching the stock market to predict silver's next move, you need to watch industrial demand trends, supply data, and physical market tightness. That's a completely different analytical framework. Third, it suggests silver could be entering a sustained bull market driven by fundamentals rather than speculation. Bull markets driven by fundamentals tend to last longer and be more stable than those driven by speculation and momentum. They also tend to reach higher ultimate price targets because the underlying demand is real and persistent. Let me give you some context on what that could mean for prices. The Silver Institute and various analysts have been putting out some pretty aggressive price targets. Some are talking about silver reaching $100 per ounce. A few are even suggesting higher levels if the supply deficit persists and industrial demand continues to grow. Now, I'm not here to make specific price predictions, but let's think about the math. If industrial demand continues growing at current rates, and if supply remains constrained, and if investment demand stays elevated, you have a recipe for significantly higher prices. It's not speculation, it's arithmetic. And here's the thing about supply. Silver mining is complex. You can't just flip a switch and produce more silver. Most silver comes as a byproduct of other mining operations: copper, lead, zinc. So increasing silver supply requires either finding new deposits, which takes years, or increasing production of those other metals, which depends on their economics, not silver's. That supply inelasticity is a huge factor. Even with prices at these elevated levels, we're not seeing a massive supply response. That tells you something about the structural nature of this deficit. Now, let's talk about what this means in the broader context of the financial system. Because silver's decoupling from stocks isn't happening in isolation. We're seeing a lot of traditional correlations breaking down across markets. Gold has been making its own moves, often independent of real interest rates, which used to be the primary driver. Bitcoin and crypto have shown periods of correlation with tech stocks, then periods of complete independence. Commodities broadly have been behaving differently than their historical patterns would suggest. What's happening is a fundamental shift in how markets are structured and how they interact. The old playbook, the one that said stocks and commodities move together during risk-on periods and diverge during risk-off periods, that playbook is being rewritten. And silver is at the forefront of that rewrite because of its unique characteristics. It sits at the intersection of precious metals, industrial commodities, and monetary assets. It's exposed to multiple megatrends simultaneously: the energy transition, the push for renewable energy, the ongoing concerns about currency debasement and inflation, the geopolitical tensions that drive safe haven demand. All of those factors are playing out right now, and they're all supportive of higher silver prices. But more importantly, they're all independent of what happens in the stock market. That's the key insight. Silver has found its own narrative, its own set of drivers, its own reason to exist as an asset class. Let me give you a historical parallel that might help frame this. Back in the 1970s, gold decoupled from the broader financial system when the U.S. went off the gold standard. For decades, gold had been fixed at $35 per ounce. Then suddenly it was free to trade based on supply and demand. And what happened? It went from $35 to over $800 in less than a decade. Now, I'm not saying silver is going to have that kind of move. The circumstances are different, but the principle is the same. When an asset breaks free from artificial constraints or historical correlations and starts trading on its own fundamentals, you can see dramatic revaluations. Silver's decoupling from stocks might be that kind of moment. It's breaking free from the correlation that kept it tethered to equity market sentiment. And it's starting to trade based on its own supply and demand dynamics, its own fundamental value proposition. And those fundamentals are incredibly compelling right now. You've got the supply deficit. You've got the industrial demand growth. You've got the investment demand from people looking for alternatives to traditional financial assets. You've got the geopolitical uncertainty that drives safe haven flows. You've got the inflation concerns that make hard assets attractive. All of those factors are converging at the same time. And they're all independent of whether the S&P 500 goes up or down next week. That's what makes this moment so significant. Silver isn't just having a good run. It's undergoing a structural transformation in how it functions in the global financial system. And investors who understand that transformation early are going to be positioned incredibly well for what comes next. Because here's the reality. If silver has truly decoupled from stocks, and if the fundamentals remain as strong as they are now, we could be in the early stages of a multi-year bull market. Not a speculative bubble that pops when sentiment shifts. A fundamental revaluation driven by real supply and demand. And the best part? Most investors still don't see it. They're still thinking about silver the old way. They're still expecting it to crash when stocks correct. They're still treating it as a speculative trade rather than a strategic holding. That creates opportunity. Because when the broader market finally catches on to what's happening, when the mainstream financial media starts talking about silver's decoupling and the supply deficit and the industrial demand growth, that's when you'll see the real momentum kick in. We're seeing the early signs of that now. The price action is telling you something. The physical market tightness is telling you something. The persistent supply deficits are telling you something. The question is whether you're listening. And look, I'm not saying you should put your entire portfolio into silver. That would be reckless. But if you're not paying attention to what's happening in this market, if you're not at least considering how silver fits into your overall wealth preservation strategy, you might be missing one of the most significant market developments of this decade. Because this isn't just about making money on a trade. This is about understanding how the financial system is evolving. It's about recognizing when fundamental shifts are happening and positioning yourself accordingly. It's about seeing the bigger picture. Silver's decoupling from stocks is part of that bigger picture. It's a signal that the old correlations, the old relationships, the old ways of thinking about markets, they're breaking down. And in their place, new patterns are emerging. New opportunities are being created. The investors who thrive in this environment are going to be the ones who can adapt, who can see beyond the traditional frameworks, who can recognize when something fundamental has changed and adjust their strategies accordingly. Silver just gave you that signal. It showed you that it's no longer playing by the old rules. It's not following stocks anymore. It's charting its own course, driven by its own unique set of fundamentals. The question now is what you do with that information. Do you ignore it and stick with the old playbook? Or do you recognize that we're entering a new era, one where silver might play a very different role than it has in the past? Because if the supply deficits continue, if industrial demand keeps growing, if the physical market stays tight, and if investment demand remains elevated, silver could be one of the best performing assets of the next few years. Not because of speculation, not because of correlation with other markets, but because of fundamental supply and demand. That's a very different proposition than what we've seen in precious metals for a long time, and it's exactly the kind of opportunity that creates generational wealth for those who see it early and position themselves accordingly. The decoupling has happened. The fundamentals are in place. The stage is set. What happens next could redefine how we think about silver as an asset class. And if you understand what's really happening here, you're going to be way ahead of the curve when the rest of the market finally catches on.